Chapter 7. College. College savings plans help you pay for higher education by using tax-advantaged asset growth to compound your college fund over time. For students and parents alike, the 5 main tax-abated college savings plans to remember are UGMA accounts, UTMA accounts, 529 college savings plans, 529 prepaid tuition plans, and Coverdell education savings accounts. To save for college, some parents open a UGMA or UTMA accounts for their children when they are still young. These parents can invest their own money into assets that will grow as their children grow up. As we talked about earlier, these accounts only offer tax advantages up to the first few $1,000s in annual gains. Gains that are taxed at the minor's capital gains tax rate, which is almost always lower than the custodian's tax rate, since your child rarely out-earns you in their teenage years. However, these accounts act as normal brokerage accounts used solely for the benefit of the child. Any money withdrawn from the account must be spent on something that directly benefits the account's minor. Additionally, the minor can spend the money in the account on anything once they mature and receive ownership of the account. These accounts are called universal gifts and universal transfers to minor act. Parents who put money in these accounts are giving their children their money down the road. Moreover, you cannot change the beneficiary of a UGMA or UTMA account. Since parents can withdraw money from UGMA or UTMA accounts at any time for the benefit of the minor, you can always invest a little money in an account to save on your taxes for the first few $1,000s your account makes. As your child nears college age, you can safely withdraw the account funds and put them into any other college savings plan directed at the minor. Why would you keep money away from minors as they near college age and UTMA or UGMA account transfer age? Aside from transferring large sums of money to young children who may not be the best wealth managers, at least before reading this book, UGMA and UTMA accounts significantly hurt children's financial aid prospects. Any money or assets in UGMA or UTMA accounts at any age are considered the student's property. The free application for federal student aid is the baseline application for college aid among incoming freshmen. The application gives students access to free federal college aid and is sent to individual schools to determine scholarship awards. In the FAFSA, a distinct division is made between student and parent assets. UGMA and UTMA accounts are seen as student assets, whereas other college savings plans are parent assets. All the qualified tax-deferred retirement plans we talked about in Chapter 6 are not considered by the FAFSA and are exempt from aid calculations, IRAs, 401ks, etc. The FAFSA and other college aid programs look at student and parent income and assets. The FAFSA parental income expected contribution brackets range from 22% to 47% of available income minus allowances, with significant financial aid available to low-income or multi-college student households. The FAFSA student income expected contribution rate is a flat 50% after an asset protection allowance that shelters dependent student income. Need-based work-study programs are not included in this income. 2008 allocation rates. On top of income, the U.S. Department of Education currently expects students to use 20% of their invested assets and saved cash to pay for college. Parents are only expected to pay 5.64% at most after an asset protection allowance that almost always lowers your expected contribution. Therefore, students with UGMA or UTMA accounts funded by parents can expect to receive significantly less financial aid because of UGMA or UTMA account balances that increase your expected family contribution. If you have already funded a UGMA or UTMA account as a parent, empty out your account 1 or 2 years ahead of when the minor will be a high school senior, completing the FAFSA to increase your available federal and institutional financial aid. You can empty out a parent-funded UGMA or UTMA account into another college plan, such as a 529 plan for your child, well before they approach college age to prevent scholarship committees from seeing bulk withdrawals as clumsy attempts to qualify for more aid. Additionally, some states prohibit you from closing UGMA or UTMA accounts just before maturity age. Finally, remember that UGMA and UTMA accounts are generally filed on a minor's tax return, and children must sign their return with you. However, you can elect to report an account on a parent's return if the child is under 19 or a full-time student under 24 at the end of a tax year, and their only income is unearned by filing Form 8814. 529 college savings plans, or simply 529 plans, like Roth IRAs, offer tax-free asset growth for expected higher education costs. However, unlike Roth accounts, 529 plans are included in FAFSA EFC calculations since they are expected to be used for college expenses. However, these plans' expected contributions are calculated at the lower parental asset allocation rate, capped at a maximum of 5.64% rather than a flat 20% for students in UGMA, UTMA, or personal accounts, 2018 rates. Investing in 529 plans offer tax-advantaged asset growth and can be used to directly pay for student expenses without adversely affecting aid more than traditional investment accounts. Investment-savvy students who open 529 plans before college or for later graduate school in their own name can still take advantage of tax-free asset growth, though they will contribute assets at their higher FAFSA investment allocation rate, lowering potential financial aid. 529 college savings plans are set up with states and qualified investment institutions, and they make sense for almost anyone planning for college or family members' college. You can invest in any state 529 plan, although most states offer local tax incentives varying from state income deductions to income tax exemptions for investing in local 529 plans. Check with your state to see how they handle 529 plan contributions. You could receive state income tax deductions for contributing to your child's 529 plan or even your grandchild's 529 plan. Remember that one child can have as many 529 plans as you want, so you can set up a deductible parent account alongside a deductible grandparent plan to maximize local state income deductions and college investing. 529 plans are managed like 401ks, as discussed earlier, with set investment options and funds managed by professionals. You can decide which fund option to invest in and change your fund twice a year with most plans, but remember that your options are limited to the options given by the 529 plan. Look around for the best state or institutional 529 plan to fit your needs. Most fund managers adjust your portfolio risk levels depending on when the intended beneficiary begins college, decreasing overall risk as college nears. When creating an account, you can name anyone of any age, including yourself, as the beneficiary of a 529 plan. Unlike UGMA and UTMA accounts, you can change the beneficiary of a 529 plan at any time by changing the taxpayer identification number in the 529 plan. This flexibility not only allows you to transfer a college fund to a new child when little Johnny decides not to go to college, but also allows you to start an account in your own name and transfer to an expected child once they are born and given a social security number. All eligible family members that can receive a 529 plan transfer without triggering a non-qualified withdrawal are the designed beneficiary's child, natural or legal adopted children, parents or ancestors of parents, siblings or step-siblings, stepchildren, step-parents, nieces or nephews, aunts or uncles, the spouse of any of the individuals listed above, spouse, first cousin, or any individual for whom the home of the designated beneficiary is the primary home the entire tax year. For that money spent on non-school expenses, note that money spent on non-school expenses is also treated as non-qualified withdrawals that are taxed with federal, state, and local income taxes alongside a 10% federal penalty on earnings. If you have extra money in an account after completing college and do not plan to attend graduate school, then consider transferring the account to another qualified family member. If you do not want to transfer the account to another family member, you can also roll your 529 account investments into another 529 plan, but not a Coverdell ESA, as we will talk about this plan soon. You can use these new plans to invest in your future children's college costs using long-term compounding. Otherwise, feel free to cash out your money out of the tax-free growth accounts after spending a big chunk on college with a small penalty plus income taxes, considering your tax-free reinvestable asset realized gains and dividend income. Remember that tax-free scholarships, Pell Grants, tax-free employer education assistance programs, and lifetime learning credits awarded to students allow you to withdraw up to the aid amount without paying the 10% penalty. Additionally, you'll pay no taxes when withdrawing contributions in this scenario, only paying income taxes on gains, which, as we talked about earlier, are generally higher than capital gains taxes from traditional gains. Long story short, use 529 plans to pay for college and graduate school. Your plan can strictly pay for tuition and fees, room and board, books and supplies, special services, and even computers and related equipment. For students living off campus but still enrolled half-time or more, room and board withdrawals from a 529 plan that exceed campus housing costs are non-qualified withdrawals. 529 prepaid plans are the forgotten little brother of 529 college savings plans. Prepaid plans are only offered by a handful of states and private institutions today because of their low popularity, flexibility, and returns compared to 529 college savings plans. State-sponsored prepaid plans let in-state residents prepay part or all of an in-state school's future tuition and mandatory fees at the current price, almost like an option or futures tuition contract for tuition. We will talk about these financial tools in chapters 18 and 21. The private college 529 plan, the only 529 plan not run by a state, allow you to lock in tuition and mandatory fee prices with a large group of nearly 300 diverse schools. If you prepay into a plan, but your child attends an out-of-state, private, or otherwise unqualified institution, then plans usually award you either the amount you contributed to the prepaid plan, your contributions plus a laughably small amount of interest, up to 2% for the private college 529 plan as of 2018, or the equivalent value of a state plan based on average applicable tuition rates that you can use to pay for other schools. This last option gives you the flexibility to invest in a safer plan, even if you worry that your, possibly very young, children may not go to a plan-specified state school. But you will likely pay the difference between in and out-of-state tuition rates if a plan offers this option. Check with your local plans to see how they handle withdrawals and unused credits. With 529 prepaid plans, you can purchase credits with bulk or installment payments that cover the future cost of a public state college year. Unit percentage credits that cover a percent cost of future state college year, or universal vouchers from the private college 529 plan that cover a differing tuition percentage depending on each participating institution. Individual states may either guarantee their sponsored prepaid plans with the full force of the state or not guarantee them at all. In guaranteed plans, the state will bail out investors and fulfill their promised credits, even if the state's plan underperforms and cannot cover its promised returns. In unguaranteed plans, investors risk losing value in their prepaid credits if the state fund cannot pay for rising tuition costs with market returns. For example, an in-state credit may be prepaid for a full year or say $12,000 in tuition. However, a state fund may have underperformed in the period in question and only left prepaying participants with $8,000 to spend. Guaranteed plans would use state funds to supplement this difference, whereas unguaranteed plans would leave you to pay the extra for your prepaid tuition. When examining available state plans, stick with state-backed plans to guarantee higher education when you prepay. The private college 529 plan's member institutions guarantee the prepaid plan. Remember, 529 prepaid plans only cover tuition. Students must still pay for room and board, textbooks, computers, and other related educational expenses. Expenses easily paid for with tax-free asset growth in 529 college savings plans. Like 529 college savings plans, 529 prepaid plans can only have one beneficiary, a beneficiary that you can easily change to another member of the beneficiary's family, limited by the generation skipping tax, which we'll talk about soon. If you expect college prices to grow significantly more than the stock market in the coming years, then prepaid savings plan accounts can be a great way to lock in or hedge a tuition price for your future college student. Let's look at historical college inflation to see if 529 prepaid plans make sense for you. Then we have two charts. First one is college inflation, inflation in U.S. market performance. It ranges from 1985 to current year, 2018, 2019, from 0%, 5%, 10%, 15%. At the top, we have an average annual NASDAQ composite return from 85 to 18. That's just a straight line. I think it's around 14%. Below that, we have the average annual S&P 500 return from 85 to 18. That's a straight line right around a little over 10%. And then below that, we have private nonprofit 4-year college inflation. That college inflation varies at the beginning. It spikes up a lot, and it's higher than everything else, but then it kind of dips down and slows down, and it goes below 4-year college inflation in public schools. Below, the next line is public 4-year college inflation, and that goes up and down, varies. Both of them are usually around 5% at the beginning. In the 1980s. They were a little bit higher, and recently in the 2010s and the latest decade, they've been decreasing below 5%, 3 to 4%. So just a general downward trend in that regard because of probably lower interest rates. As we can see with inflation at the very, very bottom, inflation is, it was a little bit high, almost 5% at some periods in the 1990s, but as an overall trend decreasing at the very bottom of the chart around that 2% mark. From highest to lowest final percent return, we see the average annual NASDAQ composite return from 85 to 18, average annual S&P 500 return from 85 to 18, private, nonprofit 4-year college inflation, public 4-year college inflation, and inflation. And then below that we have index fund performance, annual percent change from 85 to 18. And we see the S&P 500 and the NASDAQ composite with significant price spikes up and down, ranging from negative 50 to over 50 in 1990 with the dot-com bubble, almost 75-80% in an index fund growth per year, and then a crash the next year to half 50. So it shows the volatility, and that's why we have those average lines in the top, and that's also why we'll look more at diversification in Chapter 35. But those are very great charts to reference as you consider index fund performance over time. From highest to lowest final percent return value, we see the NASDAQ composite and the S&P 500. And in general, in that chart, you're going to see lower volatility in the S&P 500 and higher volatility in the NASDAQ, just based off larger percent price swings. College inflation data from the College Board's publicly released metrics. Rates reflect national average annual price changes in tuition and fees plus room and board in a given year's dollar. Tuition and mandatory fee inflation alone averages 0.3% higher for private 4-year schools and around 1% higher for public 4-year schools in this time period compared to the reported tuition and fees plus room and board and inflation rates. Note that public 2-year institutions has significantly more volatile tuition and fee inflation rates changes during this period, and these changes averaged out to just under 6% annual increases. Inflation calculated using the CPI, the Consumer Price Index. This common measure of inflation tracks the purchasing power of the US dollar by calculating the cost of a common basket of everyday goods. The government uses monthly calculated price changes in this basket of goods to track US dollar inflation. Data in this chart looks at percent changed in the fourth quarter of the CPI price of any given year compared to the previous year's fourth quarter index price. No doubt, educational costs rise faster than average general consumer goods as determined for schooling steadily increasing over time, as demand increases over time. However, does this increased cost warrant prepaid tuition? You can see that effective college inflation, hovering around an average 5.5% per annum for both public and private schools, stands significantly above US dollar inflation. Subtract the average 2.6 inflation rate from this time range from the chart, and you realize around 3% average tuition increase accounting for inflation. Remember, our conservative long-term S&P 500 return is 9% before inflation and 7% after current inflation rates. College inflation almost never historically increases more than major diversified U.S. index funds, the basis of 529 college savings plans. In the long term, stock market investing in truly valuable companies allows you to earn more future money to spend on all college costs rather than prepaying tuition to hedge against college inflation. With that said, there are some uses for prepaid plans. Stock investments are inherently volatile, as shown in the second graph. As a student nears college age, you can lower your overall short-term portfolio risk by turning towards prepaid tuition plans. At this later stage of schooling, students may start thinking about where they want to go to college, so you can prepay for tuition at a prospective university with confidence. Many investors utilize prepaid plans alongside corporate bonds at the end of a student's primary schooling to offset the risk of a portfolio downturn after significant long-term growth. Often, the realized prepaid college tuition gains from college inflation in the last few years of 529 investing yield higher returns than similarly safe corporate bonds. Prepaid tuition plans should not be the long-term basis of most well-planned portfolios because of their lower overall return on capital compared to market indices, but they can act as safe investments that decrease your overall portfolio risk as college approaches and you want to spend your money. Remember, prepaid plans are not available everywhere, and many restrict when you can purchase tuition credits. Research state plans or the private College 529 plan if they make sense for your prospective schools. See if your prospective plan imposes a student age limit for prepaid tuition. Try to sell off assets to purchase prepaid credits only when the market is up and you can take significant long-term gains. Coverdell Education Savings Accounts are the last primary tax-advantaged investment account that utilizes compound interest to help you pay for education. With a Coverdell ESA, your money grows tax-free as long as you use it to pay for qualified educational expenses. You can pay for primary and secondary school expenses, for example, primary school, unlike college-only 529 plans. Your contributions are not tax deductible like some state 529 plan investment tax incentives. Your account must be opened before its beneficiary turns 18, no age requirement for 529 plans. You must spend or withdraw the full account balance or roll the account into a new beneficiary before the original beneficiary turns 30. Beneficiaries can only receive $2,000 in contributions per year for all of their Coverdell accounts. Excess contributions are currently hit with a 6% penalty. Contributions can be invested in virtually any stock, bond, or fund. ESAs are administered by financial institutions, not states. Contribution limits are much lower than 529 plans. 529 contribution limits vary state by state and plan provider, but are often hundreds of thousands of dollars. We will further explore these contribution and gift tax consequences soon. And your individual modified adjusted gross income must be below a constantly changing threshold. You follow these steps to calculate your modified adjusted gross income. Take your adjusted gross income on your latest 1040X tax return. This is essentially your sum income less deductions. We'll talk more about tax forms in Chapter 8. Line 1037 Form 1040 AGI is on line 37. Form 1040A AGI is on line 21. Form 1040EZ AGI is on line 4. 2017 numbers. 2017 line numbers. Different form types are phasing out in 2018. See Chapter 8. Add your tax-exempt interest income to this figure. For example, municipal or federal bonds, as we mentioned earlier. Add your individual retirement account contributions. Add in any excluded income portions of Social Security benefits. Tack on any tax-free foreign earned income and earned income exclusions. Add any other tax return specific deductions such as student loan interest, tuition and fee expense deductions, 1/2 of self-employment tax, passive loss or passive income, Section 137 exclusions for adoption expenses, rental loss deductions, health savings account contributions, any overall loss from a publicly traded partnership. There you go. Your MAGI is your AGI plus any deductions or tax-free gross income, and it changes every year as you make more and more money with assets. However, unrealized gains will not change your MAGI. Beneficiaries of a Coverdell ESA can receive contributions from parents, grandparents, other relatives, friends, organizations, corporations, and themselves. Family members contributing to an ESA must have an individual or joint MAGI below certain changing thresholds. As of 2018, you cannot contribute to an ESA if your MAGI exceeds $110,000 individually or $220,000 jointly. Note that the amount you can contribute to a beneficiary decreases from the maximum $2,000 per annum as you near these income thresholds. Corporate or organizational ESA donors are not subject to income limits. Coverdell ESAs do not have preventative contribution limits like Roth IRAs, which require the investor to have earned income to contribute to an account. Some investors above the income threshold work around tax laws by gifting their children $2,000, which the child in turn invests into their ESAs on their own behalf since they are below the income threshold. Keep in mind that these contributions must still be made with post-tax dollars no matter their source. Coverdell ESAs can be transferred to new beneficiaries at any time. Since control remains in the hands of the account administrator, ESAs are treated as parental assets just like 529 plans on the FAFSA, and investments contribute to a student's expected family contribution at the lower parental asset allocation rate. If student finishes their higher education with the money left over in a Coverdell ESA, they can either transfer the account to another qualified family member, same as the 529 plan family members, or withdraw the remaining balance. Account managers can easily change the beneficiaries of Coverdell ESAs without requiring full funds withdrawal and rollover. Remember, any non-qualified earnings withdrawals are subject to income taxes plus a 10% mimicking the penalty for a Roth IRA unqualified earnings withdrawals. Qualified tax-free Coverdell ESA withdrawals cover the same expenses as 529 plans plus K-12 variations of such expenses. Although they carry significantly lower contribution limits compared to 529 plans, Coverdell ESAs can be a great way to save for private primary education and later college expenses. You can spend traditional 529 college savings plans on private primary educations. However, 529 plans are limited to spending $10,000 a year on tuition and other required fees only. However, you can spend ESAs on K-12 tuition, tutoring, special learning services, books, supplies, equipment, computers, internet access, and other possibly required expenses such as room and board, uniforms, transportation, and more. Note that you have until April 15th after the end of any year to make a contribution to a Coverdell ESA for that tax year, just as with individual retirement accounts. Any additional contributions over the $2,000 per person limit will be taxed at 6% excess tax unless withdrawn from the account by June 1st. Additionally, you can roll over ESA funds into a 529 plan without penalties. Coverdell ESAs use compound tax-deferred asset growth to send your child through private primary school, high school, and college. However, Always ensure that you have ample college savings before starting a 529 plan or Coverdell ESA to pay for private K-12 schooling. Keep prioritized college and secondary K-12 schooling funds separate if possible. The flexibility you receive with self-directed ESA investments allows you to utilize technical analysis skills you'll learn later in this book to outperform most fund-based 529 plans with your own stock trades. Although you might not receive state or local contribution tax incentives, you should consider Coverdell education savings accounts as part of your overall college investing plan. Savings plans for college gift money to growing children to invest in their educational future. Because of this, you should remember estate, gift, and generation skipping tax laws to avoid unnecessary taxes. You pay estate taxes on assets transferred after your death if you exceed your exemption. Every American gets an estate tax exclusion of $11,180,000, 2018 amount, from the assets they leave their family. The estate tax allows for unlimited deductions for transfers to surviving spouse and to charities, including unrealized capital gains. Once a stock or other asset is transferred due to a death, the asset's price basis for the newfound owner is its value on the day of distribution, thereby giving unrealized gains to beneficiaries without taxes. For example, you buy a stock for $50 and it is transferred post-mortem to your spouse at $100, who immediately sells it, attaining no capital gains taxes. The government taxes extra assets or cash above your exemption and deduction left to your family according to the following 2018 table. Taxable estate and gift would be on the left is the dollar value and the rates on the right. So for 0 to 10,000, you're an 18% rate. For 10,000 to 20, you're at 20%. For 20 to 40, you're at 22%. For 40 to 60, you're at 24%. For 60 to 80, you're at 26%. For 80 to 100,000, you're at 28%. For 100 to 150, you're at 30%. For 150 to 250, it's about 32%. For 250 to 500,000, you're at 34%. For 500,000 to 750, you're at 37%. For 750 to $1 million, you're at 39%. And anything over $1 million and $1 is taxed at 40% excess. You pay gift taxes when you transfer property and assets while living. You receive a lifetime gift tax exemption of $11,180,000 in 2018. However, this credit is unified with your state tax exemption. If married, you can split gifts with your spouse to minimize gift tax outputs, and you can make unlimited gift tax-free transfers to your spouse unless your spouse is a non-citizen. In 2018, the annual exemption for a non-citizen spouse is $152,000. When you make gifts over the yearly gift allowance, the excess deducts credits from your unified gift and estate tax credit. If that tax credit reaches zero, you pay the same tax rates on non-qualified or on non-exempt gifts as the estate tax rates above. You can give up to $15,000 a year per gift receiver in 2018 without deducting from your lifetime combined gift tax and estate exemptions. Contributions to a Coverdell ESA and 529 plans count as gifts and add towards your yearly, annual, and lifetime exemption. However, the 529 plan specifically allows you to make early 5-year lump sum contribution of $75,000, $15,000 times 5 years, gift tax free rather than 5 yearly contributions, provided no other contributions are made in the 5-year period. Married couples can receive up to $150,000 in lump sum or $30,000 a year gift, since limits are individualized. On top of all this, cash you pay for tuition and medical expenses, gift tax free as long as you pay directly to qualified school or medical provider. Still, do not fear to contribute extra money towards college savings plan. Because of gift taxes, as you will have the overarching lifetime gift tax exemption. You pay the additional generation skipping tax when you skip a generation to transfer property and assets for gifts and estates. Generation skipping taxes apply to gift and estate transfers to the recipients who are 2 or more generations younger than the donor. This tax specifically applies to grandparents opening or transferring a 529 plan or Coverdell ESA to a grandchild. On top of the generation rule, this tax also applies to wealth transfers made to individuals who are at least 37 and a half years younger than the donor. However, you also receive the same $11,180,000 per individual, double when you men marrying and contributing jointly, generation skipping tax exemption to buffer your generation skipping contributions. 2018. The additional generation skipping tax in 2018 is 40%. You can avoid this tax by transferring wealth to direct descendants who can later pass it down to your family through gifts or their estate. To report gift and generation skipping taxes, use IRS Form 709. For estate and generation skipping taxes, use Form 706. You must only report gift taxes against your lifetime deduction and possibly pay taxes once you exceed the annual allowance per individual. Watch out for state-specific inheritance and estate taxes. In 2018, 12 states and the District of Columbia impose an estate tax, and 6 states collect an inheritance tax. Estate taxes are calculated based on the value of an estate, whereas state inheritance taxes are calculated based on payment by asset recipients unless a will specifies estate payment. Some states loosely follow the federal tax rates, while others independently deviate. Check with your local institution to optimize your asset management plans.